Good morning. We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks gain after the Fed holds rates, citing uncertainty around the economy and inflation, while signaling no drastic response to President Trump's trade war.
Now, Tencent planning to speed up spending on AI infrastructure after posting its fastest revenue growth since 2023.
We'll have more on China's AI race with 01.ai CEO Kai-Fu Lee and the co-founder of startup Manycore.
Plus, an exclusive with Ping An Group co-CEO Michael Guo as China's economic slowdown and property crisis pressure the insurer's earnings. Good morning. Hope you're all well. Thank you for joining the program here. We're starting the news off here with some breaking lines coming through here out of China. So we had the loan prime rates. This is for March. This is the 1 and the 5-year rates. Short version is unchanged here at 3.1% on the 1 year, 3.6% on the 5-year. Yep. Apart from this, speaking of rates, there's a big rate story, of course, coming through out of the United States there with the Fed.
Yeah, well, I mean, sort of what we just heard there, no changes. That was really the key takeaway. But also taking a look at what we've got here, not seeing too much reaction really in the currency so far. Just to note as well, though, we are seeing some moves in metals this morning because copper has just climbed above $10,000 a tonne on the LME, London Metals Exchange, and that's the highest going back to October of last year. But broadly taking a look at the market action this morning, Chinese futures, what we're seeing so far ahead of the opens, very busy period for earnings, and really Tencent has been the standout.
Absolutely, it has. In fact, when you look at Tencent, so the fastest revenue goes in 2023. There's a massive operation to return money to shareholders, for example. So there's a buyback program. There's also an increase in the dividend. Shares overnight didn't actually react quite a bit. I'm just looking at early indications right now of how this one is probably going to open up here in the Asia Pacific. We're looking at, okay, here we go, 548 a pop. We closed at 540 yesterday. Go, Bell.
This chart I really like because it's come from our print colleagues. This is from Cindy Wang over in Taipei. But taking a look at the lead that TSMC has been enjoying over the past couple of years over Tencent in terms of market cap, that's actually narrowing because, of course, the story this year from the US side has been a lot of concern around whether that rally in AI optimism spending can be sustained. TSMC's kind of been caught up in that broader sell-off. Tencent, though, I mean, I think you're up around 30% at this point in time, year-to-date gains. But taking a look broader markets, just what's happening in the session so far today. Japan, of course, is shut for a market holiday. Yep. But broadly, we are just seeing a little bit of an advance in Asian equities, and it just seems like there's a sense of relief. You know, we could have heard Powell talking about all the negatives around Trump, inflation, the outlook, recession fears. Didn't get it too much, and so you kind of see that in the picture today.
Yeah, I mean, we'll see how markets continue to digest this because as the Fed was pointing out, right, they're taking rates down. You look at the dots, well, you look at the guidance coming through, right, -2 rate cuts, well, -50 this year. The market's still pushing towards a 3 handle on that. By the way, joining us later on the show will be Johanna Chua out of Citi to help us understand really what to make of all of that. But yeah, we are looking at gains going into the open today, ex-Japan, but when you look at futures, we are pushing a little bit weaker as far as A50 futures are concerned. Now, let's get it back to the Fed. Here's what Jay Powell had to say, talking about progress that's been made in this fight against inflation.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
Let's bring in Paul Dobson, our executive editor for Asian markets, right now to talk us through the context here. So, Paul, we're waking up right now. The Fed's taken down its forecasts for growth. It's bumped up its forecast for inflation. Is this a bad read coming out of the Fed?
You might think so looking at the changes to the forecast, but actually this is probably just about as good as it could get, I think, for the market from the Fed. What the market is hearing is, one, that the Fed thinks that any bump in inflation from the tariffs that the US is planning to introduce over the coming months will be transitory, i.e. a one-time jolt, but not a longer-term impact on the market. And two, yes, it sees slightly slowing growth, enough to encourage it to carry on cutting interest rates, but nothing like a crash or a really bad slowdown. In fact, he gave some reassurances on the idea that a recession is still not really a risk that they need to consider at this point. So the market can think the economy is buzzing on, okay, the Fed's probably going to keep on cutting rates later in the year. It's not that worried about inflation. It's also, by the way, slowing the pace of the balance sheet runoff, i.e. Holding onto its treasuries a little bit more than it was otherwise. And so overall, it's slightly good news for bond market in that it pushes down interest rates, and it's slightly reassuring for equities markets. And so we saw a bit of an uplift in the stocks as well.
What does it mean, though, for sort of longer term or at least medium term trading action? Because, stay the course was sort of the main takeaway, but then at the same time, you're staying the course in the face of so much uncertainty.
Well, that's the thing, isn't it? They can't know for sure, and they're still flying blind to a certain extent because we don't really know what the tariffs are going to look like, when they're going to be introduced, what the impact's going to be, what the retaliatory measures that we might see from around the rest of the world could be either. So much uncertainty. You have to kind of plot a course with the best knowledge that you have at the moment. And so all things being equal, that's what they're doing right now. I think medium-term action, Bell, it's very difficult to see, right? You need a crystal ball in order to try to predict that. But the fact that the Fed is thinking about this more as, a slightly negative for growth and only a temporary bump for inflation is probably how the market takes heart from it right at this moment in time.
Paul, and we will take the glass half full there. Thank you so much. Paul Dobson there in Singapore for us, our executive editor for Asian markets. Right, maybe something to give us perhaps more encouraging sign going into the open today is Tencent. We are indicated 548 right now, which is, by the way, at a price, if we open at 548, would be the highest level here going back to 2021. It's outlined plans to sharply increase its spending on AI after posting also its fastest pace of sales growth since 2023. Min Lo has been covering the story for us. Our China correspondent is here with takeaways here out of Tencent.
Yeah, it's really an exceptional quarter to end the year on for Tencent. So the company has announced 80 billion Hong Kong dollars worth of shares buyback and also to raise that dividend payout this year by about 32%. And that's after it beat analyst estimates on most of these earnings metric for last quarter. So revenue coming in at about 11% growth on year compared to analyst estimates of 8%. Net income as well, nearly doubling. And of course, a big part of this is driven by the solid demand in gaming. But investors now are most focused on AI and how much the company is going to spend on that. So when it comes to CapEx spending, the company said they are dedicating about low teens % of their revenue this year on AI infrastructure. So that's estimated to be about $10 billion, according to analysts. And it's still somewhat less than what Alibaba has announced, which is $50 billion over the next 3 years. But still, Tencent is really focusing on leveraging AI internally in its e-commerce, its mini videos, and the WeChat app, which is really well positioned given the over 1 billion users to become the next potential AI super app or AI agent. So our in-house analyst Robert Lee is saying that Tencent is best positioned to generate immediate cash returns on these AI ventures. But fair warning from Robert Lee, though, about its earnings outlook this year potentially could normalize given the limited supply of NVIDIA chips, potential tightening of export controls. The management did confirm yesterday at the earnings call that they had to make last-minute purchases of GPUs after their cloud computing growth had been constrained when they had to divert some computing resources to meet their internal demand.
Yeah, but certainly a report the market likes, because I think we've seen price targets being raised from Goldman Sachs, Morgan Stanley, and also Citigroup as well. But that was our China correspondent there, Min Lo. And still ahead, we're going to keep up that conversation on Tencent and China's AI rally, of course, with 01 AI and then Barclays as well, Dave.
Yeah, talking us through, of course, those key themes. So there's a very specific tech focus coming through on the China show today. But ahead of that, though, we're looking at earnings still. We're pivoting to insurance with a co-CEO of Ping An, joining us for an exclusive conversation after the company missing estimates there, despite, of course, this massive pop still across the top and bottom line. We'll dig into the numbers, get you the context that you need. Counting down to the open of trade here, Shanghai, Shenzhen, and here in Hong Kong. The open, just 20 minutes away. You're watching the China show. Good morning. Good morning. Welcome back to the show. You're watching the China Show. Let's talk about earnings. So Ping An Insurance reporting results. A lot of numbers here to get through, really. But effectively, what you had was the net income number, missing estimates there amid, of course, what's taking place, the softness in the Chinese economy, the property market, they're weighing on the value of new assets. But when you look at, say, comparatively growth from this time last year, so revenue growth, for example, fastest pace in 5 years, supported by investment income, which, get this, gained nearly 300%. Net income, we talked about, that missed the target, but net income itself was up nearly 50%. JP Morgan out with the notes just this morning here, talking about how they're raising shares, A and H shares, to overweight. Let's bring in the group CEO of Ping An, Michael Guo, joining us exclusively right now. Michael, good morning and welcome to the show. Thank you for taking the time. I was having a look at your financial report. There's lots to get into. You know, the core business a bit soft, investment income really boosted your bottom line. What do you think the market should be taking away here?
Well, good morning, David and Annabelle. It's a great pleasure to be here. If you look at our financial performance, we're actually quite confident of this actually being a very good set of financial performance. If you look at our investment income has been increased double digits, our OPAT, operating profit, increased by 9%. If you look at our value for business of our life insurance business, on the apple-to-apple kind of a comparison, we increased by nearly 29%. And more importantly, if you look at our investment return, given the low interest rate environment, we're able to generate 5.8% for CII. And for our life insurance funds, we're able to generate 6.0% from that perspective. So if you look at financial performance from our perspective, it's very strong. If we look at our core strategy, integrated finance and medical care and the healthcare, senior care part of the strategy, it's actually growing nicely. So when we look at, and also technology works as well, given the recent strong push on the technology and AI deployment. So from our perspective, we believe our financial performance has actually coming back to kind of a growth moment. We have seen very strong progress of our fundamental strategic perspectives. And also we're confident to be able to generate good returns for this year and the next year for our shareholders.
Yeah, it'd be great to dig into some of those details, particularly around technology, but I would also like to get your reaction to the asset management business, because this arm was just a little bit weaker, I guess. I mean, I think it was a loss of around 11 billion yuan for the period, but it does seem like prolonged property turn down, slower growth, that really weighed on the value of your investments. But can you just shed some light around that? And also, given the changing dynamics around China's economy, the investment space as well, what's your outlook?
Well, yeah, we took some very prudent provision in the asset management area. If you look at the provision that we took this year compared to the previous years, it has significantly reduced, which means the asset quality of our investment has been improving significantly. And to look at the Chinese economy moving forward, with the recent policies coming up to stabilize the stock market, to stabilize the property market, and we believe that the economy is actually coming through the bottom, actually back to the growth trend. Although it could be faster, we believe the positive on the long-term perspective, the trend is positive. So is our asset quality. And we have taken significant amount of provision on the very prudent manner. So that's why the burden from our life insurance business, from our investment part of the business, is actually reduced significantly. So we have good confidence it's going to become much better.
Yeah, and thank you for that. Thank you for the clarification. I want to actually ask a follow-up on that, because to your point, you took the precaution of recognizing some of the provisions earlier on. Should we expect things to just get better along those lines?
Yeah, we have confidence that the things will get better along this way. This year, next year, our asset quality is being improving quite nicely. Our core business, particularly, been growing very strong. Our investments has been actually outperforming our competitors. So all these things coming together, and also the reform on our life business, which is the core part of the business, been really generating good momentum. And you can see our insurance agents' numbers being stabilized, their productivity being improved on a continuous basis. So all these things giving us very strong confidence that we're able to not just doing well this year, but over the long term, we're back to the growth moment.
Michael, if I could just also focus on, you mentioned investment income, and we talked about that when we brought you in, up 300%. Certainly, the A-share market, the general greater Chinese stock market has done very, very well of late. I want to get your outlook on the market itself. That's number one. And number two, do you expect investment income to continue to be a big driver of your financial performance?
Well, if we look at our business, majority of our business come from life insurance business. And given the low interest rate environment, it's not just about driving the liability side of the business, meaning the sales and the value of new business. At the same time, asset part of the business is actually getting increasingly important. So that's actually quite important for us to manage both sides of the business. The other thing is we're a long-term fundamental asset allocator, which means we look at our investments not just for 1 year, 2 year perspective, we look at 5, 10, 20 years perspective. We allocate our assets into different asset classes. Given the recent market rally on the stock markets, we certainly believe this is going to be one of the key contributors to improve our performance on the asset side. So over the long term, we're quite confident putting all these things together. The life insurance business transformation have given us a very strong push on the liability side of the business. Our investments, portfolio management techniques and capabilities generate good returns over the long term. So both things are coming together very nicely in the future.
I want to get more on the insurance side as well, because you've got that strategy around health and retirement. Yeah. Are you planning any new moves this year?
Yes, it's actually our core strategy, integrated finance and the medical healthcare and senior care part of the services. We believe, number one, we're entering into a golden age of life insurance growth, because with China is entering the aging society, life insurance now is becoming a very fundamental part of the asset allocation for the average consumers. And coming with that is a great demand on the medical care services, healthcare, and senior care services. And that's the area that we have been investing significantly to build up our capabilities and provide high quality services, and use this to be one of the key competitive advantage and differentiators against our competitors. So this is going to be the area we continue to invest. And we have seen very good value creation through this part of the business. 70% of our life insurance customers now use these services. This has created the significant value, improved the value of our long-term customers, improve our retention rate, also improve the the length of time that they're able to stay with us. So we do believe this is going to be one of the key areas to differentiate, and we will continue to invest in this.
Yeah, I was wondering if you could elaborate further on that, because I think to your point, the trend that is fairly clear and consistent and predictable is the importance of the silver economy. And I'm wondering, from a business perspective, can you attach a growth rate that you want that part of the business to grow at in the coming years? Do you have a specific target for your team there?
Well, if we look at this part of the strategy, we have kind of three-phased approach strategy for the long term. The phase one is more about building up the infrastructure and network for our medical services, healthcare, senior care services, and using this to actually help drive our sales for the life insurance business to improve the customer value and their experience. And stage number two is to strategically enlarge the asset base of this part of the business, and this will start generating profits, contribution to our life insurance and also the group business. And over the long term, phase number three, this will become the second growth curve in connection with our integrated finance strategy. So for the short term, this is going to become the value creating driver for our insurance business. That's why you see the per customer average contribution from the insurance business has been improved. The retention rate being improved, the persistency ratios being improved, all this coming together. So this part, not able to generate significant amount of profit contribution to our bottom line yet, but significant enablement of value creation for our life insurance business.
And Michael, just very quickly, AI, you've mentioned how you're integrating it, and something that stood out to me in the report is that you're using AI agent to generate sales or realize sales. I'm curious, though, what sort of headcount reductions that you're planning for Ping An based on those improved efficiencies?
Right. So if we look at the AI's value to our business, we look at primarily two areas. One is to improve efficiency, get the cost reduction. The second part is to improve our decision-making accuracy. So if we look at those two things, Ping An has been very well known in investing significantly into technology, into digital capabilities, into AI. And you can see from some of the numbers we published, we have improved significantly our performance through the operational efficiency improvement and cost reduction. Now, we don't necessarily have to reduce the people's headcount because our business continues to grow. From our perspective, is to improve the operating efficiency so we don't have to improve our cost base along with our revenue growth. So that's the other side. That's why the improving efficiency is quite important for us to use the AI technology.
Michael, thank you so much. 非常感谢 Michael Guo, their co-CEO of Ping An Group, just helping us understand the reports that they just put out there and, of course, the outlook for the company moving forward. We're just 6 minutes to the opening bell here in Hong Kong, Shanghai, and Shenzhen. Futures and early indicators are pointing to some softness at the open. Good morning. Right, welcome back. So, I mean, there's really not much to tell you apart from nothing else is going on. And I think what's, maybe just to add to that too, so yesterday, similar picture, right? So in terms of price, not a lot of movement as far as Chinese markets. Volumes were about 30% lighter than usual on the Hang Seng Index. So it does seem this sort of period of consolidation will continue today. And of course, coming through as well here, we're looking at the likes of Tencent and Ping An, and not much reaction there to the earnings that Tencent put out. It's a big earnings day still. We'll tell you what those names are in a moment. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show this morning, counting down to the start of markets. And look, it's going to be a pretty quiet day, it seems, at least what's been indicated in futures so far. I mean, Japan is shut, of course, so that, I guess, takes some liquidity out of the market, a bit of traders as well. But generally, it's big picture. I mean, there's kind of two themes. Firstly, you've got China earnings that are continuing to roll in. Tencent is one of those, of course, today. Overseas, of course, it's really the story around the Fed and Jay Powell kind of striking that tone of just stay the course until we know exactly what's going on. Yeah, the thing is that he's brought up the transitory word again, which, of course, is when you look back in terms of market history, given the benefit of hindsight, certainly wasn't really a good thing. I mean, the Fed was correct when they said transitory inflation of 5% because it went up further from that point in time. That being said, we can talk about the Fed in a moment here. There's nothing much happening across these markets. CSI 300 is opening flat. Interestingly enough, margin debt, which is, I guess, a good indicator of risk appetite out there, has reached a 10-year high on the onshore markets. That's number one. Point number two is within this space, you want to watch things like copper and gold, for example. We'll talk about the movers in a moment here. So copper is, as you can see, 1% in Shanghai. We did pop 10,000, that level there on the LME contract, 5-month high on that. And apart from that, too, consumer discretionary names have been up for 4 or 5 days now. So that group of stocks has actually broken past the range of late. So we'll talk about that later. The open in Hong Kong and some of the big movers across your bottom of your screens coming through in Tencent. And we're down about 2% there in the open. Okay, so we are reversing some of the early indications here. Maybe a sell in the news. It was a good set of earnings, beating estimates, good growth,
good buyback, increased dividend. We'll unpack that even further. But again, this is, I guess, a case of profit taking right now. In light of still massive amount of earnings coming through today, and certainly this sort of AI thread that's really stitched itself just about across sectors, whether that's tech, we talked with Ping An earlier on, and how they're using technology. So yeah, lots to talk about, lots of AI to talk about. I guess we have someone to help us do that, Bill.
Yeah, well, actually, to your point, I mean, this is sort of the year where we start to see really AI being applied across a range of different industries. And let's get more on that now, because we've got Kai-Fu Lee. He's the CEO at 01.ai and also chairman of Sinovation Ventures. And it's actually, I mean, it's perfect timing because you've just launched an enterprise large language model that's also going to be deploying DeepSeek more broadly. But talk us through exactly what it entails.
Well, I think China had its ChatGPT moment when DeepSeek came out. We can call it DeepSeek moment. Everyone's aware of it over the Chinese holidays. Everyone's talking about it. And the CEOs came back to work saying, put DeepSeek to work at my company. And what they found out was DeepSeek is a fantastic model, amazing AI, but it doesn't have the middleware and the user interface that it takes to connect to corporate databases, to build applications, to make it useful for HR, finance, and customer service. So what 01.ai did was we saw DeepSeek has been making great momentum, and we decided to really bet on DeepSeek and build that missing middleware and UI so that DeepSeek can be made useful in corporations. That's the product we announced this Monday, and we're getting fantastic reception in China and also in Hong Kong.
Tell us more about that launch.
So we launched on Monday, and what we talked about was many of you have DeepSeek now. You love to use it. In fact, one CEO friend of mine asked his employees, what do you use it for? And
good question.
And the answer was fortune telling. By the way, that's a great thing to try for you. But it's not very deep into the industry, the company. You know, every company has ERP and the CRM databases. They have employee records. They have their internal information. And they want the model to be more a generalist. They want it to be knowledgeable. Bloomberg would want a finance knowledgeable model, right? Ping An would want an insurance knowledgeable model. So our job is to really build that layer for that purpose. It's sort of like if I gave you a Windows kernel that is the core operating system, you wouldn't know what to do with it. You need all the Windows layer, the application interfaces, so that the Windows kernel can be useful. And we like to think that 01.ai is providing that layer for DeepSeek, which is the underlying model and technology.
And using DeepSeek as the underlying model, I mean, obviously you could have chosen other models instead, including from the US. What does that tell you about where the competition or I guess the race for supremacy stands between China and the United States right now?
Well, clearly in both US and China, the pre-training of a giant model has consolidated and is consolidating. And it's become clear that open source will be the winner. There's still many that will not concede. Right? OpenAI, Anthropic, who build their businesses believing they can build a better closed model than everyone else. I think they got shocked when they saw a model as good. They would argue nearly as good, but either way, they're getting it for much, much lower cost. If you think about OpenAI's cost of $7 billion of operating costs in 2024, DeepSeek probably operated with 2% the operating expense. So the issue really isn't whose model is 1% better. I think they're all very good. But the issue is OpenAI's model even sustainable, right? I mean, you're spending $7 billion a year, making a massive loss, and here you have a competitor coming in with an open source model that's for free. And that company also is infinitely lasting because this founder has enough money to fund it at the current level, and has reduced the cost of computing by a factor of 5 to 10. So with that kind of formidable competitor, I think Sam Altman is probably not sleeping well.
Yeah, well, you do think, I mean, obviously, the DeepSeek would have really challenged some of the monetization strategies around AI. But at the same time, given that AI is so commoditized now in China as well, that open source approach. How many AI models do you think that the Chinese market can actually sustain?
Well, I think probably, I'm guessing 3, DeepSeek, Alibaba, and ByteDance. And they'll evolve over time, right?
Okay, there's a few names missing on that list.
Yeah,
Only 3.
Well, there will be many other who aspire to build one,
right.
And we'll see if there's a 4th player. But even within these 3, I think DeepSeek currently has the momentum, and that's why we're embracing that. But I also want to point out that I wouldn't say AI is commoditized. I would say the underlying pioneer model, foundation model, that is trained with a huge amount of money is commoditized. It costs a lot, and it's hard to really compete with open source. But AI is not commoditized, right? It's like, Windows kernel, Linux kernel, that's kind of commoditized. But Windows is not commoditized. Microsoft makes a ton of money. And what 01.ai wants to do is build Windows and use DeepSeek as our Windows kernel.
And is that where you think the value added comes now? In other words, for VCs thinking about where the value added is in this industry, it's no longer, for example, AI, for example, still presents that value. And I want to understand, for example, the economics and why you think, say, there's only room for 3 as well.
Well, there may be room for 4, but in most markets, you end up with room only for 2, right? The winner who makes a ton of money, the runner-up who breaks even, and everyone else who dies. And this one is exacerbated because it's hard to monetize the underlying pioneer model. But once you are the winner, there are many ways to monetize it.
Right.
So that's the trick. For the VCs in both U.S. and China are moving away from wanting to fund more pioneer models. They're happy to fund AI infrastructure, AI applications, consumer apps, because every app will be remade, right? And also enterprise apps that can provide real value add to enterprises. So AI funding is going gangbusters. It's just that nobody wants to fund pioneer models.
Does China's innovation, though, come up against the headwind this year of greater restrictions on China's access to advanced semiconductor technology? Is that going to end up presenting a problem?
So we can look at historically, right? China is able to catch up and build great engineering products while U.S. is better at making breakthroughs. That was what I argued in AI Superpowers, and that continued to be the case. The GPU sanctions came 2 years ago. And today, we actually see DeepSeek not only resilient, competitive, but also basically made true the statement that necessity is the mother of innovation. That because they had so few GPUs, they had to make it 10 times more effective. So I think I would argue that the sanctions so far hasn't worked. It's hard to project the future. But I would say that DeepSeek actually benefited from having less resources and able to make training and inference at 5 to 10 times lower the expense incurred by OpenAI and others.
I remember, so DeepSeek was, what date is it? March 20. So let's call it 2 months ago. I remember we had the chat on the show, I think it was back in October, where you guys actually launched something similar months before DeepSeek. And so you guys came out, DeepSeek came out, and then since DeepSeek came out that moment, just the cadence and the frequency of all these ones coming out with their own iterations of it. I guess my question is, what do you make of the frequency? What is behind, you think, the frequency of these releases? And is DeepSeek the symptom, or is it the cause of what's going on? In other words, what can we expect from the industry this year?
I think it's still ultra competitive. The fact that I think China will have 3 winners, U.S. might have 4 winners at the end, doesn't mean dozens of others will not want to compete. So I do expect frequent releases to continue especially from the fast-moving companies. And I think the fastest-moving companies probably are xAI's Grok and DeepSeek. I'd say these are the fastest. And then I think OpenAI, Alibaba, Google, and Anthropic are, of course, all making respectable moves. I listed ByteDance because they're not on the list by people, but we know how much they're spending. And I think one way you can justify spending a ton of money on pioneer models is because you have so many customers that when amortized over many, many customers, you can make the business case. And ByteDance has more customers and more ways to monetize than anybody, so I would make that speculation.
Yeah, I think Baidu is one of the names that sort of stands out to me, not on that list, and maybe you can share some reaction on that. But also government support from Beijing. Exactly how do you see that also shaping up over the coming year?
Well, we all respect and thank Baidu for really starting the transformer revolution in China. They tried to hire Jeff Hinton and ended up hiring Andrew Ng. And I think that shows that Robin has that kind of vision. The execution is currently lagging, and we'll see what happens. Yeah. And your other question was? Yeah.
Government support.
Government support, right. So the Chinese government's new big direction is called new quality productivity. What that means is using high tech to create productivity, efficiency, and really turn all the traditional industries into more profitable, more competitive by the use of high tech, and AI is at the very core of that.
Actually, sorry, a final question for you. Sorry, because you mentioned the word consumption in AI was actually mentioned in Premier Li Chang's work report from the NPC, and to the point that Bell was making on, government support. It was rare that we saw just, the CEOs of China's big tech companies in the same room as the president, for example, weeks before that. And I'm wondering tangibly, what measures do you think we could see from the government to be able to back up, really, what really see it as very, very good optics?
Yeah, I think right now the local governments probably are the most active in trying to see, I'm City X, I'm the party secretary, mayor of City X, and this city is very strong in the following industries. How would I apply AI to create this new quality productivity in these industries that will end up helping the growth, the GDP of the city? And I think, having a single direction from the top, new quality productivity, is very, very effective and invigorating to the cities. And we're seeing a lot of interest for our company and our peer companies to work more closely with these local cities.
All right, Kai-Fu, thanks so much for joining
Fantastic.
us. It was a real pleasure to speak with you, and congratulations on the release of the new platform as well. That was Kai-Fu Lee there, CEO of 01.ai and Sino Ventures chairman as well. We'll have plenty more ahead. This is Bloomberg. 15 minutes into the session this morning, and we've got benchmarks just slipping a little bit so far. Tech actually the notable decliner, off 2%, and Tencent as well. It came on in the green. It's now flipped into negative territory. That's even after the company outlined plans to sharply raise spending on AI infrastructure, and as well posting its fastest pace of revenue growth since 2023. For more, let's bring in Zhong Xiao. He's China technology analyst at Barclays. And your reaction, are you surprised to see Tencent in the red even after those set of numbers?
I'm not surprised at all. The expectation were very, very high heading into the quarter. I love to talk about Tencent, but if I can just add, I was enjoying watching your conversation with Kai-Fu earlier. I just want to add one thing, because we have written extensively on AI, on DeepSeek. What DeepSeek has done is not only to prove to the world the training a very, very good model can be done very, very cheaply, but also they told the world how to do it. It became an equalizer in a way that's why everybody else's model in China and around the world all of a sudden has become a lot better and as good as DeepSeek's and as good as other sort of top tier models in the States. Now back to Tencent. I think the result, the quarter was almost flawless, right? They accelerated growth across all major segments. The domestic gaming grew 23% year over year, international gaming 15%, and advertising re-accelerated growth, growing 17.5%. In total, the revenue growth was above 11%, and that was the highest in the last 4 years almost. and the margins expanded significantly. They grew revenue 11%, and they grew profits by 30%. We couldn't find anything wrong with the result, and there are many other sort of nice progress beneath the numbers. For example, earlier you were talking about AI with Kai-Fu. Tencent sort of started late, but I would definitely not counting them out as one of the top leaders eventually. They came from behind. Now their chatbot is among the top 3 in China now. They just spent, $5 billion and bought tons of chips in the fourth quarter, and they're laying the strong foundation for the future growth in 2025 and beyond to accelerate their cloud growth as well. And last but not least, I think David mentioned earlier about how strong commitment they have in terms of shareholder return. They bought back, roughly speaking, $15 billion stocks last year and $5 billion dividends. There are very few companies in the whole world, especially in tech, that would return $20 billion a year to their shareholders.
Right. Okay, well, the simple question I have now is, do the good times continue this year?
Yes, absolutely. We put out a saw piece earlier this week. We have been a strong believer in the pivot is real this time. The pivot started end of September, right? The government has turned around 180 degrees to now pro-growth, pro-market. They have done that before in terms of one-China policy and even COVID, as you know. 180-degree pivot is not unusual in China. Now, since the pivot, we already started to see a lot of consumption stimulus in Q4, and that already started to trickle into companies' results. Not just Tencent had amazing results, the best in a few years. Both Alibaba and JD reported much better than expected results, probably the best results in the last 3 years. You started to see that already, and year to date, the consumption stimulus has been sort of strengthening in a way. Cell phone sales, as you know, the subsidies are 15% of any new phone sales, selling for less than 6,000 renminbi. So you start to see a lot of these things are happening now. And you mentioned earlier the meeting between Xi and Jack Ma and all the tech titans in China about 2 weeks ago. That just shows you the government is now re-embracing the tech players, the private entrepreneurs now.
Okay, let's see what that means for the stock itself. We're obviously in the 500s on the stock. The market's re-rated as far as AI and tech. You could also argue there's a premium that's been removed because of, to your point, the regulatory environment has changed. What drives the stock up from here? How much is the stock worth?
Well, Chinese tech stocks have been among the cheapest in the world, right? Even despite the mini rally from the lows earlier this year, end of last year, companies like Alibaba, even Tencent, they're all trading at a low to mid-teens multiple. And some of the companies like JD is even trading at the high single-digit kind of multiple. That's a fraction of what investors are paying for the U.S. tech stocks. Now, we have been saying investing is really a global sort of scene, global game, if you want to call it, because global investors, when they think where to put their money, they can pick and choose. Every country has their problem. Now, it's harder for me to say this. Today, the uncertainty in the U.S. is even greater than the uncertainty in China. And 2 years ago, you guys may remember, many investors called China uninvestable because the policy was just so drastic and random, and companies and industries just get destroyed overnight. After school tutoring, just to name one, right? Now, in the States, you don't know what's going to happen tomorrow, what's going to happen to tariff, yes, no, another 200%. So as a result, there's a higher level of uncertainty today in the U.S. than in China, I would argue.
Zhong Shao, that's all we have time for. We didn't get to the fact that it's a good story. I'm wondering if it resonates in the community you're in New York, with that investor there. We can talk about that next time. Zhong Shao there, China tech analyst at Barclays, live for us there out of New York. Thank you, by the way, for staying up for us. Plenty more ahead here on The China Show. Right, welcome back. We're looking at copper, we're looking at gold, the prices themselves. We're looking at mining stocks as the second derivative here. To the moon. As you can see, Jiangxi copper's up 3%, copper's up above 10,000. The LME contract, I think we're also seeing some gains of about 1% here. Also on the contract in Shanghai, gold record after record after record. Yeah, so this is really one bright spot across the markets that feels fairly lethargic this Thursday. Yeah, and we'll talk more about this coming up. And, of course, it's a Fed macro conversation that we need to sort of dig into here.
Yeah, and we're going to do that actually with Citigroup Global Markets. We've got Johanna Chua joining us in a few minutes' time talking about the Fed. Markets being a little bit wary about EM during President Trump's second term. Welcome back to the China Show. Taking a look at the Hong Kong session. We're half an hour into trade this morning, and we've just seen really broadly coming under pressure. So it's not really sort of the same hymn that the other markets in the region have been singing this morning, because we have seen them moving higher. We had seen them moving higher after the Fed just sort of largely stayed the course and continued to go with that wait-and-see mood, but we are still seeing Chinese equities under pressure and really being led by tech in particular.
Yeah, we'll continue to track this. I think volumes are still on the lighter side of things. And, as Bell's pointing out, on price and tech really leading to the downside on the China story. The other thing we're tracking is also a drop, but this is in CGB, this is in yields, and being led by, it's coming up on your screens now, we're down about 3 basis points on the Chinese 30-year yield. Some PBOC injections coming through here. Not any major reduction or major announcement of any sort of policy easing, which, the market's been waiting for, and perhaps why that, the short end is already at 1.5% there on the 2-year yield. The other thing we're tracking here is everything on FX, right? So we had the Fed with a flurry of central bank decisions this week, including the BOJ. You had, of course, all the politics and the drama coming through out of Turkey with the equity market down about 8%. At one point, the exchange rate was north of 40. We pulled back a little bit right now after maybe some herding coming through there. Dollar Indonesia's there, 16.50.28, of course, coming through as well out of a central bank decision over in Indonesia. Very, very quickly, the state of other markets in the region, it's really very quiet. We're flat. Asia ex-Japan. Japan, of course, is shut for...
Ooh, now you're really testing me. I'm going to quickly get it. Now you've really tested me.
What is it? Vernal Equinox Day. And just to mention as well, it also coincides, because there's nothing else to talk about, maybe a little bit of astrology here. Jupiter is no longer in retrograde this week. Yeah.
I cannot
see how you can use that for your investment decisions.
I cannot understand what that actually means.
Neither do I.
Okay. Well, we did actually speak with Kai Fu Lee, and he was saying that you could use
to predict my future.
Exactly. Use ChatGPT to predict your future, or another DeepSeek, for instance, equivalent. But we can get back to the top story, or what has been one of the top stories. That's the Fed, away from horoscopes. Jay Powell downplaying growth concerns and the impact of Donald Trump's trade war on inflation. Take a listen.
There's always an unconditional possibility of a recession. The economy is strong overall and has made significant progress toward our goals over the past 2 years. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us. Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas. Uncertainty around the changes and their effects on the economic outlook is high.
Joining us here on set to talk us through those major lines is Johanna, Chua, head of EM Economics at Citigroup Global Markets. Good morning. Nice to see you.
Hi, good morning.
The last time the Fed mentioned, or at least brought up the concept of transitory, we know what happened there. So how much should I believe them right now?
Well, obviously, now we take it at their face value. I mean, there's a lot of question mark to some extent. This tariff should eventually, hopefully we get some clarity eventually at some point. And right now, it's too uncertain at the moment. So I think they're still couching this transitory language, which is why even though he's talking about relatively resilient kind of growth outlook, the market really took the FOMC meeting at the margin as a bit more dovish. Although we were actually expecting, hopefully, a more dovish dot plot adjustment. We didn't get that. But I think this transitory kind of language is important. The fact that he sort of downplayed the surge in inflation expectations from the Michigan survey, putting more weight on the New York Fed survey, which is a little bit more benign, also kind of is consistent with that narrative.
Yeah, I was actually going to point out, so exactly about that UMich survey, that it really was, I think it went back to sort of a 3-decade high for the reading.
32-year high, I think.
Yeah, for the 5- and 10-year expectations. But I guess in the interim period, and we were just speaking with Paul Dobson there, our executive editor for markets, he was sort of saying this is as good as it could have got from the Fed.
I think so, because actually a number of people were even worried that we might even have a more hawkish move in the dot plot. So the fact that we didn't see that big change, I think, kind of provided a bit of relief for the market. But again, there's so much uncertainty. We're still going to get more tariff noise after April 2nd. The other thing that we have to factor into the inflationary pass-through is in the past, just like in 2018-19, the strength of the dollar helped counteract some of the inflationary impact of the tariff. But as you know, this time around, the way FX is behaving, including how Renminbi is reacting, kind of has the opposite reaction so far. We're actually getting a little bit of a dollar weakness in the run-up to this. So I guess it's a question of we still have to see how bad these things are going to get, and also what the trajectory of the dollar is going to look like.
So what type of probability should we be attaching to, say, stagflation coming through?
Look, actually, our house view is we don't expect stagflation or persistent stagflation. I mean, I think our view is, we're a little bit more dovish. We actually think there are signs that, the economy was already slowing down before even all this tariff noise was happening. And now that you have introduced a lot of uncertainty, we're expecting first quarter GDP growth in the U.S. is going to contract by 0.1%. I mean, not as bad as what the Atlanta Fed is suggesting, but that's still quite a bit of a slowdown from, the run rate of growth in the U.S. close to 3% last year. And again, we still have a lot of uncertainty we have to deal in going into 2Q. Not to mention that, hiring, although there hasn't really been major layoffs, hiring was already slowing down in the run-up to this. So, look, I think, we are a little bit more benign we're more worried about kind of the slowdown of the growth. We're actually also a little bit more benign than the Fed in terms of our outlook on core PCE. I mean, they're forecasting like 2.8. We're more in the, 2.3, 2.5%. So I think there's still that's why we're still thinking that the data that will come out, both on the labor and the inflation, should be a little bit more dovish, and that should pave the way for the Fed to ease further.
Yeah, and the question there is, when do you think the next move would be to the downside on the Fed? Because dot plot says 2, market says 3.
Right.
And so far the guidance from the Fed is we'll stay put until the data tells us otherwise. How quickly could that turn?
So our view is obviously they're going to stay put for a while, but we actually are expecting the next cut may happen by May. I think that's partly on the assumption that hopefully by April 2nd we will get a little bit, or sometime in April, we should get a little bit more clarification on what this whole reciprocal tariff is going to look like, and this whole America First trade policy. And then hopefully we're expecting that the data, both on the inflation and the growth side, will lean towards maybe the Fed eventually moving. But again, Citi is a little bit more on the more dovish view in terms of our pace of rate easing. And admittedly, obviously the market, the way the market and the FOMC guidance has obviously leaned a little bit more hawkish in our house view.
So what's the expectation around how the dollar trades?
Right. I think right now, obviously the market was taken aback by how much, obviously, the dollar has really not reacted to tariff risk premium. I think, actually our strategist is a little bit worried that, maybe we are too complacent about, this is the time to sell dollar. That at the margin, we're still expecting going into 2Q. We actually have, a short euro bias because the worry is that people are overexcited or extrapolating too much of the growth impulse from the announcement of the fiscal side coming out of Europe and Germany, but that in reality it's going to take time for that to be implemented, and the multiplier effects of that will probably be quite low, and we're not going to feel the effects of that until 2026 and later. And meanwhile, so therefore, given this kind of growth differential argument, and we also have to remember, despite all this worry about U.S. growth amplified by the uncertainty and Doge-related cuts, in reality, U.S. is still a lot more closed than other economies, say in Eurozone and East Asia. Part of the reason why we're still a little bit, focusing more on the U.S. slowdown than the rest rest of the world is maybe partly because of the scope of the shocks coming out of the U.S. And also there's been quite a bit of export front-loading as well. I mean, we see that in Asia, in East Asia. And the worry is if we do get underlying slowdown in demand, we could get a reversal in the payback. Not to mention we're going to get more escalation in 2Q. So that's why we're a little bit more cautious about kind of chasing significantly dollar weaker from here.
So when we look at, I think, consensus growth forecast globally for the year, downside risk to that, that's question number one. And, when you look at EM, for example, which you oversee, which economy is most exposed to that?
Look, obviously on the trade side, it's really going to be, who is most exposed to volatile goods trade? It's going to be East Asia, obviously very open economies like, Singapore, Malaysia, Taiwan, the Korea, etc. And then obviously Central Eastern Europe, because it's also quite exposed, depending on really, Europe has not faced the brunt of tariffs yet. Like EU has just had targeted tariffs, and we're so focused on the fiscal side. So I think that is a source of risk. But, on the flip side, where the narrative also changed at the margin, and we just have to see how this is going to pan out, is despite the fact that China has gotten the worst of the tariffs so far, and again, we have to see how bad this is going to get. We don't quite know because we're getting very mixed messages from Trump that on the one hand, the actual action has been quite, more relatively hostile to China on tariff, but the language and rhetoric seems to still be open to some sort of negotiation. But the China story also changed because this whole AI, deep sea, there's other idiosyncratic stories that are happening. And so relative to the beginning of the year, we didn't factor in that some of this AI hype, excitement and state support is now galvanizing more capex or more confidence for capex, and that could help. And then the other thing that's also helping China at the margin in terms of the narrative is we used to be a lot more cautious on the outlook for real estate in 2025. And I think now at the margin, we're seeing some resilience and light at the end of the tunnel, especially for top tier cities. And, with the injection of more kind of consumption-based stimulus, maybe it's not as bad as we expected. So actually, we recently upgraded our growth forecast in China to 4.7% this year from 4.2%. Oh. So again, a lot of moving parts. But of course, the risk really here, the wild card really here is what exactly is going to be the U.S. policy approach, obviously on China. And, it's hard for me to believe we're done now. I think we're still going to get more action for sure. So that's something we need to watch out for.
Yeah, the night is early.
Yeah, I'd say, again, early innings, definitely. We're going to have more with Johanna Chua from Citigroup Global Markets staying with us. But still ahead as well, we'll get a closer look into China's AI race with the startup Manycore Tech. That's one of China's 6 little dragons. We're going to be hearing exclusively from co-founder Victor Huang about the company's global expansion plans as well. More ahead. This is Bloomberg.
You're watching the China Show, just some breaking news, and you're looking at live pictures. I believe this is Tel Aviv. And the Israel's IDF in a Telegram post in the last few minutes or so, talking about how sirens have been sounding in some areas. The details are still under review, following what the IDF says is a projectile that has been launched from Yemen. That's what we know so far. And you're looking at live pictures of Tel Aviv, where I imagine those sirens, to the point that the IDF are sounding the alarm at those times at 4 in the morning. We'll get you more details on this once we have more.
Yeah, and also just around this period, we've also heard President Trump, he's been back on his Truth Social posting this morning, saying that the Fed would be much better off cutting rates. He's also saying that the central bank should do what he calls is the right thing in that post, essentially thinking that easing is maybe the best approach as US tariffs start to make their way into the economy. But yeah.
Well, that's a preference. And, when you look at, I think, the conversation we were having earlier on, which I think will continue, is if the tariff conversation is driving this increase in inflation expectations, then we kind of know what the cause is or the potential trigger then for lower rates ahead. Get rid of the tariffs. But anyway, I'm not the U.S. president, nor are you, That's the preference, though, there, out of Donald Trump in the Truth Social post. Let's bring back in Johanna Chua here, head of emerging market economics at Citigroup Global Markets. I think we can table the Fed for now. Like we've covered that enough. What I want to talk about is China. Is the economy recovering quicker than we think it is?
Look, at the moment, if you look at some of the data that's come out, the January, February activity data combined, I mean, generally, it does show that the economy seems, there's a little bit of life, a little bit more resilience from kind of a huge escalatory kind of growth fears last year. But again, at the same time, we shouldn't over-extrapolate at this point. There's still a lot of lingering challenges, obviously, in China. I mean, confidence is still quite low. I mean, obviously, people are still very unclear and uncertain about jobs and income prospects. Even though there's a little bit of life in some segment of kind of tier one real estate, the overall real estate market is still struggling with kind of excess supply-demand imbalances. So we are still expecting overall property prices may still fall nationwide, even though it's falling at a lower pace than last year. Yeah. And then we still have, obviously, the exogenous shocks coming out of Trump. I mean, we don't know exactly what other kind of things can come out. I mean, right now, there's a lot of excitement about this whole AI race and support for that. But I think there's still a lot of worry that Trump might still tighten export controls even further, more and more in terms of the, equipment, the chips. So those things, again, can continue to create a lot of noise, not to mention we're so focused right now on kind of, restrictions on trade flow, so what can happen on trade on the back of aggressive policies. You never know what Trump will do on financial flows. I mean, he's already talked about, restriction on investment flows. So there's a lot of things we still need to watch out for.
We put a story out today talking about how China is, well, for one, I think they're looking to consumption to be as an antidote, I guess, to the uncertainty out there. The other thing that we've started to notice, and I'm wondering what you're seeing, is that we're seeing exports to EM pick up because of the closure in some of the other gates. And I'm wondering, are you seeing a pickup in Chinese exports to their trading partners? And is that something that can, boost growth and can continue and crowd out maybe some other markets?
Well, look, it's been a theme that we've written about over the last years. That actually, last year we wrote a big piece talking about the South-South flows, trade flows. Yes. And a big part of that is China's exports to the rest of the global South, particularly ASEAN, LATAM, Of course, the problem with that is although exports have increased a lot to places outside of the U.S., a lot of the trade surplus that China has gained last year was actually at the expense of also the global South. So that's why you're also seeing, some selective pushback. But you're right. I think generally China's attitude is they've been able to de-risk from the U.S. exposure. Like in 2017, they used to rely 19% of their exports went to U.S. Now we're down to 14%. In 2017, exports to U.S. was like 3.6% of their GDP. Now down is 2.8% because they've been able to reroute and build kind of more networks around it and find new markets. So you're right. It helped them a little bit. Of course, the question really now is, well, to what extent is Trump also going to put tariffs, not just on, exports coming from China, but will Trump also, give a hard time for rerouting destinations like Vietnam or Thailand, where the bilateral trade surplus with the U.S. is also relatively large, and there's a lot of concerns about trade diversion. So there's also risks around that. But you're right. I think that kind of diversion of trade and finding new markets helped China, but it's not a sustainable strategy because remember last year, even though China grew 5%, 30% of their growth came from net exports. And when you're the second largest economy and the question is how much can you, rely on that? And obviously some of these countries, are also pushing back a little bit, which is why this year we really need to focus more on domestic demand, in particular consumption. And you're absolutely right. The narrative now is coming out more in terms of consumption support. It's just a question of whether it's going to be large enough or big enough to really dramatically change the optics. Now, for now, we think there's enough momentum there that, as I said, we upgraded our GDP growth forecast. So we're at least close to the around 5%. But, part of that is also on the assumption that really to get confidence going, you kind of need to put a floor on property prices, at least some segment of property prices. So this is why, and these things, although we're seeing some signs of better life, these things can be fragile, right? So we really need to watch how the data and how the policy unfolds throughout the year.
And just very quickly, if we do continue to see incremental improvements in China's economy, does that also become inflationary on the global scale?
No, look, at this point, China has been exporting a lot of deflation to the rest of the world over the last couple of years. Yeah, at the margin, if they can successfully boost demand, yes, at the margin that would help. But again, it's a question of how much will they really boost demand. I mean, there could be a bit of rebalancing, but, it's a question. I mean, there's a lot of talk now in China that they might now start doing a bit of supply side reforms, especially, whether it's steel or particular metals, and maybe that's an effort to boost PPI PPI deflation, to kind of address some of the PPI deflation pressures. But I think for consumer, a lot of that really depends on confidence, right? And they are doing something, but it's still, to us, it's still a lot more targeted. We didn't get a lot of big surprises coming out of NPC that suddenly, and again, we don't really feel that there's been very strong signaling in addressing deflation. And just to add to that, the fact that last year we thought they were signaling a more moderately loose monetary policy, but this time around, because of the way in which this tariff negotiation is happening, the price action on renminbi has been a lot more stable, notwithstanding the tariff. Yeah. And I think because of this kind of preference for renminbi stability for now, that I think unfortunately has an alternative consequence, which is meaning that monetary policy is being kept artificially too tight relative to what is optimal. So that again counteracts to the reflationary kind of drive that we were hoping to get.
All right, Johanna, thanks so much for your time. That was Johanna Chua, the head of emerging market economics at Citigroup Global Markets, and we'll have plenty more ahead. This is Bloomberg.
I think China will have 3 winners. U.S. might have 4 winners at the end. Doesn't mean dozens of others will not want to compete. So I do expect frequent releases to continue especially from the fast-moving companies. And I think the fastest-moving companies probably are XAI's Grok and DeepSeek. I'd say these are the fastest.
That was Kai-Fu Lee, CEO of 01.ai and chairman of Sinovation Ventures, speaking to us on today's show. And an emerging player in the Chinese AI space says it's looking to grow its global presence. That's even as Washington tries to limit the country's access to high-tech semiconductors. Manycore Tech co-founder Victor Huang told us exclusively why he still sees great international potential.
I think just for the future, currently, I didn't see any risk. It's pretty easy to buy the GPU what we need, and we also rent servers globally. So our business is not only in China. So right now we didn't face any trouble with the GPU.
The sort of geopolitical tensions and the risks that the US further restricts China's access to advanced technology isn't something that has such a big impact on your business today.
Right now, we didn't face any such trouble because we embrace the open source ecosystem. The open source ecosystem is open to the whole world. We also contribute our efforts to the open source ecosystem. We in the GTC, we released our new open source software called Spatial ML for spatial recognition.
We know that AI generally in China, it's a very competitive landscape. How important is it for you to offer good pricing, essentially, and cheaper pricing than competitors to your customers?
We want to get as much users as possible. That is our strategy. We don't want to just earn too much money from every customer, but we want all the customer will affordable to our product. That is very important for our goal. So that is the day one when we start up our company. We are going to optimize our rendering system to become cheaper and faster, then make it available for all the user and customers.
Yeah, there we go. Conversation, of course, with Victor Huang there with Bell yesterday. Manycore Tech chairman, of course, one of the six
little dragons.
There we go.
Yeah, they burst onto the scene in Hangzhou early this year, and led by DeepSeek, of course, but still very prominent startups within China.
Yeah, I have a feeling that won't be the last we're going to hear from.
I hope not.
There we go. More on that in a moment. Let's have a look at, speaking of, joining us from San Jose, California. Speaking of California, Tesla was granting this permit in California to offer ride-hailing services, and some of the suppliers that we're seeing across the region To be honest, no reaction there. Let's have a look at CGBs, please, if we can, and the pullback we're seeing across yields, 3-4 basis points now. In fact, we're down to about 4, so we are flatter on the curve. And as you can see, the bull flattening taking place after this injection coming out of the PBOC coming through it as well. Do we have U.S. Treasuries? We don't. I'll tell you more about it in a moment, with the Fed, of course, coming through and saying, there's a lot of transitory forces forcing inflation to the upside. It's better to wait and be patient and see how things settle. Welcome back. We are going into the Japanese lunch break. Usually would be the case. It doesn't mean because the markets are closed, people are not going to have lunch. So do enjoy, of course, what is awaiting you, of course, as far as nutrition is concerned. Japan is, of course, closed today for vernal equinox day. There we go. Asia ex Japan up 0.1%. S&P futures are seeing a bit of a bounce today. Volumes are on the lighter side across most parts of the market, not all. We're zeroed in on consumer discretionary shares in particular, and we are seeing a flat on the regional benchmark because on the CSI 300, that's really one pocket of the equity market that's really risen above the tide this week so far, amidst a consolidation taking place across Chinese tech and the pullback we are seeing still last we checked on that. Right, Fed story still ongoing. Treasury futures, Japan is close to no cash treasuries, and we are seeing a pickup there as far as Treasury futures are concerned, just about across the board. So yields would be down, and they are likely going to be down once things resume, of course, I believe, towards the London hours. There we go.
Yeah, and something else we've been tracking this hour as well is what's happening in Tel Aviv, because the Israeli Defense Forces say Sirens have been triggered, or rather parts of Israel have been triggered by projectiles launched from Yemen. This comes after the truce in Gaza disintegrates, with Israel beginning limited ground operations in the region. Let's get more with our senior editor, Bill Ferries, joining us. So, Bill, this is obviously a fast-developing story, but just bring us up to speed exactly on what's been happening.
Well, as you mentioned, Israel's saying it intercepted a projectile that was fired at it from Houthi base in Yemen. They have had these happen in the past, and they don't tend to be successful, but it does show the reach of the Houthis in Yemen in terms of being able to target Israel. They, of course, have said that they would ramp up their escalation against Israel and against shipping in the Red Sea after the U.S. began again striking targets across Yemen and saying that they would continue in an unrelenting fashion against the rebels. So the broader picture is, as with the limited invasion of Gaza we've seen from Israel and the increased strikes in recent days and the U.S. action against Yemen, the ceasefire that had been in effect seems to have basically collapsed, and we're seeing a resurgence again in the conflict in that region, with the U.S. also making threats against Iranian targets as well, but not actually going after those yet. So very tense situation in recent days, and it looks like that's going to continue.
And Bill, just to pivot, where we are seeing maybe the tension and the temperature come down slightly, at least compared to the last time these two individuals had a conversation, was with President Zelensky and President Trump on a phone call. Friendlier tone there compared to that exchange in front of the world, of course, that took place in the Oval Office. What took place during that call a few hours back?
Well, the readout from the U.S. side, from Secretary of State Marco Rubio and the National Security Advisor Mike Waltz, they called this a fantastic call between the two leaders. This was officially President Trump's chance to debrief President Zelensky on Trump's call with Vladimir Putin the day before. The readout very positive in terms of how President Zelensky responded to all that. Zelensky accepting the idea of not hitting energy infrastructure targets. It's still not clear whether Vladimir Putin will go forward with that proposal, but Zelensky thanking Trump for providing Javelin anti-tank missiles early in Donald Trump's first term, and saying he looked forward to hearing about the discussions that are now scheduled to take place in Saudi Arabia between U.S. and Russian officials in the coming days. So as you mentioned, a complete shift in tone from what was, I think, about 3 weeks or so ago, that complete breakdown in the Oval Office. We're in a different place right now. And really the onus, I think, is seen as being on Vladimir Putin to commit to a 30-day ceasefire that he's so far refused to agree to.
Bill, and hopefully the momentum, the current momentum, just to point that out specifically, continues here in this direction. Bill Ferry's there, our senior editor over in Singapore for us. Right, some of the other big political stories that we're tracking at this point in time. Taiwan has identified 2027 as the potential year for a Chinese invasion in its annual military drills. The Defense Ministry mentioned that the date for the first time in a documents briefing lawmakers on upcoming drills, now which will simulate an attack by the Chinese military. Now, Beijing held military drills around Taiwan earlier this week. Now, the Philippines wants India to join a military alliance to push back against China's rising assertiveness in the Indo-Pacific. Manila's military chief, Romeo Bronner, told Bloomberg that he wants India to become part of the squad along with the U.S., Australia, Japan, and also the Philippines. Now, he says that he likes like-minded nations must collaborate on intelligence and military exercises. Right, let's stay in the Philippines, but pivot to monetary policy, where the central bank governor, we spoke with him yesterday, talked us through really that he only sees currently a modest impact from this ongoing global trade tussle. Remolona also told us exclusively that the level of uncertainty this time, though, is a tad higher than the last time.
What assumptions are you making about what the Fed may be doing and the impact on the currency, the dollar here?
What we've seen so far is not so much what the Fed has been doing. The big factors have been geopolitical risk. When there's an event that makes people worry about geopolitics, then the dollar strengthens. It's a safe haven currency. Even now, it's a safe haven currency.
But what do you see the Fed doing? Some suggesting it will cut 3 times this year, 25 each time. Do you make that assumption as you look at your own monetary policy?
We just follow what the market says the Fed will be doing. And so the market is now saying 25 basis points in June. So in our models, we stick that into our model and see what happens.
There are also murmurings that perhaps the U.S. economy could be headed for a recession. Do you see that?
I don't see a recession, but I think a slowdown is very, very likely.
And of course, this is against a backdrop of tariffs imposed by the Trump administration. Might that have ripple effects on the Philippine economy?
Oh, absolutely, absolutely. The tariff war is likely to slow down growth for everybody and then raise inflation for everybody. By how much, we don't really know. But the bigger factor is the uncertainty itself. A change in tariffs, we can stick that into our models and then we can act on that basis. But the atmosphere of uncertainty is very different from this time. So that's harder to get a handle on.
So how badly might that hit the Philippine economy? Would it derail perhaps your 6% target, which you're confident of achieving?
The baseline calculations that we've made suggest a very modest hit on the Philippine economy. We'll be hit somewhat because we're part of a global economy.
That was the Philippine Central Bank Governor, Remolona, speaking exclusively to Bloomberg's Haslinda Amin. And cheap Chinese goods, just shifting now to what's today's big take. They're flooding emerging markets as Trump's tariffs force manufacturers to find other countries to export to. And that has led to a ripple effect for some in Asia. Let's get more with our Asia economics correspondent, Katya Dimitrieva with us this morning, and this is being called the new China shock, and we just mentioned there Asia, but just tell us exactly where it's happening in the region.
Yeah, and China shock 2.0 or 3.0 is how you could put it. I mean, we've seen it for years, starting in the 90s with the U.S. and sort of wide-scale job loss, economic hit. But this time what we're noticing happening is it's happening to emerging markets. So a lot of the allies of China and Chinese officials, and even in the region here in Southeast Asia. So Vietnam, Indonesia, Thailand, they're all facing this flood of imports, whether it's steel all the way through to clothing, textiles, shoes. And you're seeing that impact very clearly on the ground. So kind of wide-scale job loss, factory closures, and a lot of these unions are pushing officials now to take a stand against China and these companies.
And what's been the response so far from those specific governments?
They're really in between a rock and a hard place. It's really tough because if you're a country that relies on foreign direct investment from China and you have officials that are very close, just geopolitically, you are kind of stuck. You can't really do the kinds of things that President Trump has been doing in the States. So far we've seen sort of value-added taxes. We've seen a 7% tariff on these small packages, so things like Temu, Shein, that when companies ship to these countries. And also steel. Steel has been the big one, so tariffs on steel. But it's really just going to get worse, especially when talking about reciprocal tariffs April 2nd. It's just really going to push a lot of these goods to go further outside of the U.S.
I guess one sort of unknown is China's focus to try and boost and lift consumption within China and make that a greater economic driver than exports. Does that change the picture at all?
Yeah, it could if it ends up happening, if it ends up being successful. As you mentioned, officials have really been targeting consumers and hoping to lift spending. But the programs they've announced so far, they haven't really put numbers around that or kind of a clear strategy. So a lot of investors and economists are still wondering, is it going to be enough? And if it's not, then of course they'll go tried and true export route. And that's exactly what they've done for the past few years.
Fantastic. Thank you so much. Katya Dimitrieva there, our Asia economics correspondent. You can check out that story and more on it, the details, the graphics, and yeah, everything in between there. That's today's Big Take, the new China shock. You can find it on the terminal and also on the internets on Bloomberg.com. Plenty more ahead. This is Bloomberg.
We're back to our interview now with the AI startup Manycore Tech. It's looking to grow its global presence despite tensions between Washington and Beijing, casting a shadow over China's tech advances. Manycore is known as one of the country's 6 little dragons. That's companies that have transformed Hangzhou into an innovation hub. Co-founder Victor Huang told us exclusively how the designation has changed the conversation with customers and investors.
We are very happy to be one of the 6 dragons, but I believe there will be more and more high-tech company to be famous like us. It's also make us easier to get in touch with potential customer. And before many people in the embodied AI industry, they are not know who you are and what is Manycore Tech. But now it's make us much easier to introduce ourselves. They are going to just more willing to try our solution.
How many more people are also now approaching Manycore to work for the business?
Before, it's very hard to hire the talents just from top university. Right now, I think it's totally changed. Just the people from all over the world and from all the China, the top talent, they are going to get in touch with us. They are send a resume to us, want to join us. And during these 2 months, many top talent from like Tsinghua University, Zhejiang University, Beijing University, even from Stanford, Harvard, they are sending resume to us. Then some of them already join us. I'm really just feel really amazing about the current situation.
I want to ask about your customer partnerships, because one of those for Spatial Verse is with Agibot, which is a relatively well-known robotics startup from China as well. How does it work in practice exactly?
If you are going to training robot in physical world, it's really hard. Normally, you need more than 10,000 scenes for a robot to training one small action, or we call it small AI model. But 10,000 physical room or physical space is really hard for AI training in real world. Can you imagine you need to find 10,000 space in Hong Kong? I think it's mission impossible. But in real world, you can not only have 10,000, you can have 100,000 or a million. It's easy. I make an example. Just in the physical world, if you want to make a space, you probably need to spend like at least 100,000 Chinese yuan in China. In Hong Kong, it's probably need $1 million. But in virtual world, like for our system, it's probably less than 1,000. So it's much cheaper and faster.
Talk to us about also, you have plans to expand more globally. So what exactly does that look like for Manycore?
We have the users from more than 200 countries and regions. We have a local team American, Korean, Thailand, Indonesia, Malaysia, just more than 10 countries. We have local team to serve them. So the globalization are different, but our global business is also growing very fast, especially for the freemium model.
There we go. The chairman of Manycore Tech, Victor Huang, speaking with Bell. Of course, they're on, Bloomberg TV. Okay, and in case you missed that, you can check out TV Go, of course, for Bloomberg clients, and you can catch up on that specific conversation, plus the many others we've had here on the shows. At least here on the China show specifically today, we spoke with Kai-Fu Lee on the state of AI in China. We spoke to Group CEO, the co-CEO of Ping An Insurance. So yeah, check that out on your Bloomberg terminals. That's on TV Go. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China show. So earlier we spoke with the co-CEO of Ping An Group, and effectively he thinks that the company is actually back in growth mode after a full-year revenue coming in and expanded at the fastest pace in 5 years. You take a look at the property slowdown and the drag there. It's weighed on the value of assets, but Michael Guo does think and told us exclusively why he expects the longer-term trend to be positive.
If we look at our financial performance, we're actually quite confident of this actually being a very good set of financial performance. If we look at our investment income has been increased double digits, our OPAT, operating profit, increased by 9%. If we look at our value for business of our life insurance business, on the apple-to-apple kind of a comparison, we increased by nearly 29%. And more importantly, if you look at our investment return, given the low interest rate environment, we're able to generate 5.8% for the CII. And for our life insurance funds, we're able to generate 6.0% from that perspective. So if you look at financial performance from our perspective, it's very strong. If we look at our core strategy, integrated finance and medical care and the healthcare, senior care part of the strategy, it's actually growing nicely. So when we look at, and also technology works as well, given the recent strong push on the technology and AI deployment. So from our perspective, we believe our financial performance has actually coming back to kind of a growth moment. We have seen very strong progress of our fundamental strategic perspectives. And also, we're confident to be able to generate good returns for this year and the next year for our shareholders.
Yeah, it'd be great to dig into some of those details, particularly around technology. But I would also like to get your reaction to the asset management business, because this arm was just a little bit weaker, I guess. I mean, I think it was a loss of around 11 billion yuan for the period. But it does seem like prolonged property turn down, slower growth, that really weighed on the value of your investments. But can you just shed some light around that? And also, given the changing dynamics around China's economy, the investment space as well, what's your outlook?
Well, yeah, we took some very prudent provision in the asset management area. If you look at the provision that we took this year compared to the previous years, it has significantly reduced, which means the asset quality of our investment has been improving significantly. And to look at the Chinese economy moving forward with the recent policies coming up to stabilize the stock market, to stabilize the property market, and we believe that the economy is actually coming through the bottom, actually back to the growth trend. Although it could be faster, we believe the positive on the long-term perspective, the trend is positive. So is our asset quality. And we have taken significant amount of provision on the very prudent manner. So that's why the burden from our life insurance business, from our investment part of the business, is actually reduced significantly. So we have good confidence it's going to become much better.
Thank you for that. Thank you for the clarification. I want to actually ask a follow-up on that, because to your point, you took the precaution of recognizing some of the provisions earlier on. Should we expect things to just get better along those lines?
Yeah, we have confidence that the things will get better along this way. This year, next year, our asset quality is being improving quite nicely. Our core business, particularly, been growing very strong. Our investments are being actually outperforming our competitors. So all these things coming together, and also the reform on our life business, which is the core part of the business, being really generating good momentum. And you can see our insurance agents' numbers being stabilized, their productivity being improved on a continuous basis. So all these things giving us very strong confidence that we're able to not just doing well this year, but over the long term, we're back to the growth moment.
And really, in the thick of earnings season for Chinese companies, these are some of the ones that are going to be reporting on Thursday. Actually, Prudential is one that was out early this morning. And for that company, we saw a drop in new business profit last year. And so China's slowdown weighing on buyer interest there as well. But certainly, I mean, we just heard sort of those competition dynamics as well. It is ramping up amongst the insurers in China. What else is standing out? I think on that board today, going to be a lot of focus on CK Hutchinson. And if we get any sort of commentary in the earnings call or in earnings at all on the blockbuster ports deal. And that's also, we had reporting, I think it was a Bloomberg scoop, about the scrutiny now that's being levied on that by Beijing. Absolutely.
Potentially blockbuster if it goes through. And the commercial sense and the benefits that they reap from that as well. Like in the meantime, though, as Belle was pointing out, right, so Ping An and Prudential were out with earnings. We're seeing a downdraft across the region today. Meituan is actually out. We're down about 2.7%. And I think the story there is more supervision that pertains to, I think, food delivery and food safety. It's concerned. We will just leave you with a look at copper and gold mining stocks to strengthen supervision of food delivery services, to be more specific. Copper's on the up, gold's on the up, and we'll leave you with just a mention of Xinhua talking about President Xi Jinping's trip to Yunnan, talking about how he is emphasizing sustainable growth for the tourism industry. We'll leave you with that. We'll see you all tomorrow. This is The China Show.